All right, let's get right into it. Today, we're going to crack the code of the financial markets, and we're going to do it by demystifying one of its most powerful tools, the candlestick chart.
So, have you ever pulled up a chart that looks like this and just felt completely lost? Yeah, if you've ever been overwhelmed by a screen full of these red and green bars, trust me, you are not alone. They can look like some kind of secret language, but I promise, by the end of this, you'll know exactly how to read them.
Because really, that's all these candles are. Each and every one is just a little snapshot, a single round in the non-stop fight between the buyers, we call them the bulls, who want the price to go up, and the sellers, the bears, who want the price to go down.
So here's our game plan. We'll start by decoding that basic story. Then we'll zoom in and break down a single candlestick. After that, we'll look at some really key patterns, and we'll wrap it all up with 3 golden rules that put everything into context.
Okay, first things first. Before we can read sentences, we've got to learn the alphabet, right? Well, in the language of charts, the most basic letter is a single candlestick. Understanding this one little thing is the foundation for everything that comes next. So what's the official story here? A candlestick chart, and this is a cool little fact, actually started with Japanese rice traders centuries ago. It's just a brilliant way to visualize 4 key pieces of price information over a specific amount of time, whether that's 1 minute, 1 day, or even a whole week. So let's break this down. See the thick part of the candle? That's called the body. It tells you where the price opened and where it closed. And those thin lines poking out the top and bottom, we call those wicks or shadows, and they show you the absolute highest and lowest prices the asset hit during that time. It's so simple, but it packs in so much information. Now the color is the easiest part. It tells you who won the battle for that period. If the candle is green, it's bullish. That means the price closed higher than it opened, a clear win for the buyers. If it's red, it's bearish. The price closed lower than it opened, a victory for the sellers. It's really as simple as that.
Okay, so we know our letters. Now we can start forming words. See, when you put a few of these candlesticks together, they can create patterns that give us some pretty powerful clues about what the market might be thinking of doing next.
Let's start with this guy. It's called a starting big bullish candle. And, the name itself gives you a pretty solid hint. This is often a sign that a brand new upward move is about to kick off with some serious power behind it. But here's the crucial part. It's all about the context. You'll usually see this pattern after the price has been kind of quiet, just moving sideways. Then, all of a sudden, bam, this big green candle shows up, breaking out of that boring range. It's a loud, clear signal that the buyers have just grabbed the steering wheel. But what happens if you see a very similar-looking big green candle, but in a totally different spot? Well, that brings us to the ending big bullish candle. It looks almost the same, but its meaning? Yeah, it's the complete opposite. And this is a perfect example of why context is everything. This candle shows up at the end of a long price run-up. It looks really strong, but more often than not, it's the last gasp of buying energy before the trend just runs out of fuel. It's a sign of exhaustion and that sellers are about to take over. All right, next up we have the doji. You can spot this one from a mile away because its body is just this tiny little line, and that happens for a very specific reason. The opening and closing prices were almost exactly the same. So the story here is a perfect stalemate. You had buyers pushing the price way up, and you had sellers pushing it right back down, and by the end of it all, they ended up right back where they started. Neither side could claim a victory. This is the market just taking a breath, pausing, and it often signals that a trend is losing its momentum. Now for a real classic. This is one of the most well-known reversal patterns, the engulfing pattern. It comes in 2 flavors, bullish and bearish, and it can be an incredibly powerful signal that the market is about to make a sharp turn. Now, the rules for spotting an engulfing pattern are simple, but they are super important. First, you need a clear trend. Then you need 2 candles of opposite colors. But the real key is that the body of the second candle has to completely swallow, or engulf, the body of the first one. It's such a dramatic visual, and it signals a very sudden, very powerful shift in who's in control. So, knowing the letters and some of the words is great, but to really become fluent in this language, you need to understand the grammar. These 3 golden rules are what separate just spotting patterns from doing truly effective analysis. And here they are, the 3 golden rules, and they're in order of importance. Number 1, the long-term picture always beats the short-term noise. Number 2, where a pattern shows up on the chart is more important than what the pattern is. And number 3, the most important rule of all,
The overall direction of the market is more important than anything else.
Rule number 2 is captured perfectly by this simple but really profound quote from our source material. A pattern that signals a bottom is only meaningful if it actually appears at a low price. It sounds so obvious when you say it out loud, but it's a rule that so many people forget in the heat of the moment.
And look, this right here is a perfect example. Seeing a classic bottom pattern after a huge run-up in price, that's a trap. An experienced analyst would see that and just ignore it, because its position makes absolutely no sense. Context is king.
Which brings us to that final, most critical rule. The trend is your friend. Your single most important job as an analyst is figuring out the primary direction of the market, because every other decision you make should be built on top of that understanding.
So if there's one thing you take away from all this, let it be this. Candlesticks are not a crystal ball. They don't predict the future, they aren't magic, they are a tool. A really, really effective tool for reading the story of the market as it's happening right now, for understanding the balance of power between buyers and sellers in real time.
So, the next time you look at a chart, I want you to stop seeing a random bunch of red and green bars. I want you to see a story unfolding. And I'll leave you with this question to think about. What's the first story you'll look for? The big, decisive victory of the bulls or the bears? Or maybe the quiet indecision of a market that's about to make a major move?